Hello and welcome to India Market Open. It is the last day before we all go off for Christmas. Long weekend ahead. Markets also in a little bit of a holiday mood this morning.
Absolutely. Now, the wait is for the Santa rally to pick up. It's probably we're going to see if that happens over the next 4 or 5 trading sessions in the US. But here, definitely the mood is very festive, Niraj.
Yeah, just ahead of the festive season, and more importantly, just the fact that there was a big scare day before yesterday.
Yeah.
But the markets have found support at 21,000 for the Nifty, for the Bank Nifty, and the broader markets performing very well. I think we can take heart from all of that.
And I think the fact that we moved on so very quickly, right? There was a little bit of a freak that moments did happen, but the very next day, I think that weakness got bought into swiftly to close the market positive yesterday.
Absolutely. It's looking like clearly signs of a technical correction, which is something that we saw overnight in the US as well. So that's a broader theme that you can definitely see playing out. So let's take a look at how US markets, how Wall Street has performed, and they shrugged off those negative cues quite efficiently. So smart recovery from Wall Street. The Dow closed about 300 points up. Same for the Nasdaq and S&P 500, both about 1.5% up in positive territory. So a lot of cues and data that has come out overnight in the US markets, and let's just go through them. One, jobless data which has come out. So essentially the attempt is still going on to figure out what's happening with the economy, whether that Goldilocks situation, soft landing is going to happen. So weekly jobless claims rose to 205,000. That's short of estimates, which is a good sign for the economy. On the other hand, you had Q3 GDP estimates. Now, these are estimates that the Commerce Department in the United States puts out. The second estimate that they put out was 5.2% growth for Q3, but they have lowered that a tad to 4.9%. So the economy is not pacing as fast as was previously thought of. One key data point which will come out overnight, and that will be key for the markets, that core PCE data, that's personal consumption, expectations. This is important because that's what the Fed looks at very closely. But that Santa rally prep is definitely on. Let's just talk a bit about what's happening on other parts of the global news flow and come to crude. So crude had slipped a bit once Angola decided it's going to exit OPEC. So in terms of actual production of crude, Angola is not a very big player, maybe tiny, won't make an impact to the amount of crude that's available, but it's also telling people that OPEC is not really in charge, and their attempts to cut down production to increase prices is not necessarily working. On the other hand, you have these concerns of what's happening in the Red Sea. So Brent, at least Brent has stayed around $79 a barrel. The U.S. Treasury was benign, continues to stay below the 3.9% mark, so no big issues over there either. Europe did not participate in that kind of a rally and was in the red to some extent. So those were the major global cues that we saw, but it's setting up nicely for perhaps a good day of trade. And guys, I talked about the Santa rally, and this was something that I was looking up. Where did that term actually come from, and what does it mean? Because we tend to use it in the context of all of December, but it's technically the last 5 trading days of the year and the first 2 of the next year. And it's important because it sets the stage for how markets are going to perform in all of Jan.
Yeah,
I think that's why we were calling it an early Santa rally, right? Because it actually came in much ahead of the last 5 trading days of December.
But that's what's happened in the recent past, right? The data of Santa rally in the US has just been completely unreliable. The last few years, it's been anything but predictive of what could happen. So, I mean, but it's a great term because it's a festive season. It's a feel-good thing, so most certainly.
Yeah.
But
helps news channels for sure.
Well, yeah. Does that help the trade today? That's the key thing. Now, so the good part is from the trade side of perspective, the Nifty closed near the day's highs, which is actually a great thing. 21,000 acted as a very key support, a big key support for our markets in trade yesterday, so which is actually a good sign. On the Bank Nifty as well, I think this is important because on the Bank Nifty, you saw put action being very important. So you saw put writing observed, strong put writing was observed at 47,500 and 48,000 strikes on the Bank Nifty. Now, this is important because if the Bank Nifty were to rally, and it was not the principal mover for a better part of day before yesterday, or in yesterday's session, but if the Bank Nifty, and then it put up a strong show, 47,840 is the spot level on the Bank Nifty. So wedged right in between those two important strikes, if we can take out 48,000 on the Bank Nifty, that could further aid the up move on that as well. So that's to be kept in mind. But I think because the FI activity, you could argue, will be missing. These days, you never know, right? The way a lot of historical predictive indicators are not predicting the right thing. We don't quite know if FIs will necessarily be absent, but suffice to say if they're absent, then the action shifts to the mid-cap and small-cap end of the market. And something that Hiren Ved was talking to us about as well, and a bunch of others have said, we're seeing some consistent buying in spec chem stocks, and frankly, that's one pocket that you got to monitor. It's not necessarily showing up in the numbers right now for these companies, but that's when you buy into businesses which are cyclical at the bottom of the cycle, buy into great companies, and if indeed the numbers pick up, then you might actually start seeing that. And we've seen some signs of that, Samina, in some smart investors buying into one spec chem stock yesterday, but just the last few days, a clutch of these stocks have made their presence felt.
Indeed, it's been interesting. Of course, too early to call it a trend of sorts, but the markets, and talking about FIIs, Niraj, we're going into an extremely long weekend for the US. You've got Monday that's off for Christmas, 26th will be Boxing Day, so traders won't be coming up to the foray until the 27th, which really leaves only 3 to 4 odd trading days for the month. So I don't think we should be expecting too much activity in terms of flows. Movements may happen, but they'll come on very light volumes, and that's what you want to keep in mind. So while yesterday's recovery, like Niraj said, came in, the markets ended positive, all sectors participated. For now, at least, Niraj, fair to assume that we won't be making any more new life highs over the next few days?
Well, you could argue, but the broader end of the spectrum might continue to do. Just the activity out there is quite insane.
Yeah, gaining 3 to 4% a day seems to be usual now for the Wall Street at least. But let's take you to stock-specific trades because there'll be enough and more opportunity in specific counters over the next couple of days as well. And today is no different. I'm going to quickly pull up a few names that we are watching out for. LIC, important from a news announcement point, the government has granted a one-time exemption to achieve a minimum shareholding of 25%. Now, this is critical because usually what happens is that the government would have to ease its stake in a company or in LIC in a 3-year period. This was an overhang on the counter, but now they've come out and said that it will require a minimum, they would be given rather 10 years from the date of listing to achieve minimum shareholding, which also means that the overhang on LIC may continue because you might not see things turn around as quickly as the street would like. The stock went home with marginal gains, may see a little bit of selling in early hours of trade. Zomato, not largely going to move the counter, but worth a mention for sure. Dipinder Goel has denied news of a likely acquisition of Shiprocket for $2 billion. He has said that Zomato remains focused on its existing business and says that he has no plans for any acquisitions, at least at this point of time. Watch out for the counter, went home with gains of about 2% yesterday. All Cargo Gati, All Cargo Logistics. Now, this is an interesting one because yesterday there was one demerger and one merger that's happening. So what happens now is All Cargo Logistics will be demerging its export business into a new entity and, of course, separating its domestic business where it will merge All Cargo Gati into All Cargo Logistics. Positive for shareholders because this will create significant wealth in form of a demerged entity. The stock All Cargo Gati went out with marginal gains yesterday, and All Cargo Logistics as well gained in yesterday's trade. The restructuring is largely to keep its international business separate from its domestic business. That's the other one. Another one that I know Niraj tracks quite closely is Ami Organics. Niraj, specialty chemical space, it's not had a great run, but there's been so much activity on the stock. Counter went home with gains of 5.5%. Promoter family has reduced its stake from 17 to, I believe, they sold 12% yesterday, to down to 5%. But it's got snapped up. So from your smaller hedge funds, you've also the larger mutual fund players who've come in and picked up the 12% stake.
Yeah, and some very smart investors there. So ICICI Prudential is one, which is 1.35, but Malabar India Fund, Sumit Nagar, very astute mid-cap, small-cap picker per se. They've bought in about 1.31. Value Quest is now a very large fund, 10,000 crores AUM, but Ravi Dharamshi, again, a very smart pharma chemical analyst amongst other things. They've bought 1.86% stake as well. So, and during closing hours of trade yesterday, there was an announcement on the exchanges about they getting into an MOU with the government of Gujarat for something related to EV. I don't remember the exact amounts of verbatim, but so clearly something's happening here, and there's some clear delivery-based buying that we saw yesterday. Naturally, because of the bulk deals, but price 5% higher and about 97 times the 1 month average volumes mark for delivery.
Explain this to me, and I know this because you track this closely. The promoter family has reduced its stake over the course of the last, whatever.
I don't have a complete handle on the promoter family reducing the stake.
17%, I don't know. I don't think the founder family is at the helm of affairs anymore. But yeah, their stake is down significantly to now only about 5%. So clearly minority shareholders.
Wow.
If the outlook is so positive, this is what...
You could argue, but the same piece. Now, like I said, I don't have a complete handle on
R&D
on that. But the point being that a lot of these stake sales are getting lapped up by very smart investors. So it'll be interesting to talk to one of them. I'm sure at some point of time in the next 20 days, we'll speak to both Ravi Dharamshi and Sumit Nagar and try and talk to them about these things.
So there is still value in the market, which is what we'd like to believe. It's not all about momentum. I mean, the fact that these smart investors are picking up counters is very obviously a sign that value still remains in this market.
Yeah. Some other stocks, Zomato would be in focus. The way the overhang on LIC is off, Dipinder Goel kind of swiftly made sure that the overhang on Zomato will also not be very large. So he denied news of the likely acquisition of Shiprocket for $2 billion. The talk was that because the last round on Shiprocket was less than $1.5 billion. Why is Zomato paying so much? But Dipinder Goel saying that, there's no truth to this and therefore watch out for this one. Jefferies stays bullish here. GMR Airports is interesting, not only GQG buying in the business, but NIIF yet again putting in money. So this is 675 crores in the Bhogapuram airport because NIIF had earlier invested in the Goa airport as well. So that's to be kept in mind. Credit card spend data was steady for SBI cards. HDFC Bank and RBL Bank spend share inched up, so therefore watch out for these as well. And just lastly, some delivery-based buying. So we spoke about Ami Organics seeing that, and naturally because of the bulk deals, the delivery volumes were very high versus the 1 month average. But look at the others. Suzlon, 4% higher, with the quantum of delivery marked yesterday about 10 times the 1 month average. Tarsons, 13% up yesterday, 6.5 times the delivery volumes. Shyam Metallics, nearly 10% up at close yesterday, 3.3 times the delivery volumes. And Thyrocare, even Metropolis actually, but Thyrocare, I'm using one as an example here, 7.27% higher, 4 times the 1 month average. So good going really. Maybe India's time has actually come.
It has, and I think it came a little while ago. But of course, the market's preempting, and like Niraj says, Mr. Market always knows, and maybe Mr. Market knew this a few months ago. Just a couple of other stocks that you might want to keep an eye on. May or may not be market moving, but worth marking this for sure. In the case of Tata Motors, they've received a no objection certificate from the exchanges to convert their DVRs to ordinary shares. Niraj, quick one. Any impact on the count if the DVRs get converted to ordinary shares?
No, I don't quite think there'll be a material
impact. It shouldn't
be
much of an impact, but worth a mention, UPL, they've also got a board meeting coming up, and this is to discuss fundraising via equity. So some dilution there could be what's expected on the cards over the next couple of weeks. Brokerage reports, so you have a Jefferies buy call that came in on Siemens, so that counter will be in focus. You've also got Mahanagar Gas Limited, another one where there has been a buy call on the stock.
No, just this, Samina, you are right, because Jefferies has upped the target price from 4,520 to 5,000. So that's a 28% uptick in the price target that Jefferies has given on Siemens. So that's an interesting one, yes.
And they've also said the energy demerger process, which is to get kick-started, is possible by 2025. So that could be the key reason why they've upped their price target by about 28%. But that's pretty much the stocks. But I think back on the macro focus, Tamanna.
Yeah, and a crucial interview that was given by Prime Minister Modi to Financial Times is on focus, and it's important to look at it closely because A, it's a rare sit-down interview that the Prime Minister has given to a foreign organization or a global organization like the FT, but more importantly is the message coming across for investors. And when I say investors, not just stock market investors, global investors, domestic investors of all kinds of hue. So the broad overall line is that India is on the cusp of a takeoff. And we've just gotten some key excerpts from what the Prime Minister has said. So he says, people of India now have a very different aspiration from the ones they had 10 years back. They now realize our nation is on the cusp of a takeoff. He goes on to say that they want this flight to be expedited, and the best party is the one who brought them so far. So confidence is being communicated in this interview of the BJP coming back to power in 2024. That's a key indicator that the markets are looking at as well. So that becomes important. He also goes on to say that how India has gone from fragile 5 in 2013 to the 5th largest economy. And remember that a lot of the narrative, global narrative around India, and we sometimes look at it in the context of fund flows, etc., is about how this has become the most tangible and feasible alternative to China. So that context is important of how we've gone from fragile 5 to this place. He also talks about transformative steps that have been taken from clean India to digital infrastructure. He's talking about infrastructure building taken off and employment generation accelerating. So all of these are very important factors that he's talking about. Employment, definitely, because that continues to be something that the government keeps responding to. There are claims that employment is not generating quickly enough, or there's not enough employment opportunity. That is something that the Prime Minister has also responded to. I found this quote important, where he says, our foremost guiding principle in foreign affairs is our national interest. And think of when India decided to buy crude from Russia and how that has changed the parameters for us as an economy and as a nation right now. So that's important, and also his response to the question of unemployment. So all in all, some key messages coming in from the Prime Minister to the Financial Times ahead of what is going to be a hectic election season, and this is something that the markets are truly watching. So, Niraj and Samina, in the context of what is going to dominate the conversation over the next 3 months, this becomes crucial.
Most certainly. And yes, Tamanna is right, because it's a rare act by our Prime Minister when he's talking to FT. And by the way, just following up on that is this lovely observation from Natixis. Now, they're a large asset manager, over $1 trillion of AUM, I think $1.2, $1.3 trillion of AUM. But I think what they have said is something that everybody should keep in mind when thinking about the structural India story. And I like the point that they are making, that one, India is a mirror image of China's debt, demographic and deflation woes, because corporates are deleveraged. The debt ratio is 54% of GDP versus 78% in 2012. So that is part one, very important point. With the inclusion in the JPM bond index, bond flows will rise. That is 2. 3, and the most important thing, which I think we are now starting to see over the last 3, 4, 5 years, and I think this will only increase, that Indian households, and guys, this is a very important point, right? I mean, we all know about it, but it's just structurally such an important point that she says that Indian households will open their wallets and invest on the rise of the investment cycle as they rotate out of deposits and gold into pensions and mutual funds. It's not just participation in equity, but participation in the infrastructure building process, because we know that some of these funds are also financing those projects. So Indian households participate in equity and infrastructure and capital building, and therefore it's just, as she rightly said, a mirror image of really what's happening in China.
Right. In fact, on a funnier note, you had Saurabh Mukherjee saying that he's moving his FD money. So, I mean, one of the top fund managers of the country also has fixed deposits. But talking about what she said, Niraj, she's also indicated that India's inclusion in the government bond, India's government bonds inclusion in the JP Morgan bond index is again a huge positive. So that will also help higher flows. She also goes on to say that while India might have a lot of problems debt, demographics, and deflation aren't one. So those are your three key triggers, and our dependency on foreign inflow is obviously reduced substantially now, right? With all the fixed deposits now moving into mutual funds and pension funds.
Yeah, we're not starting to see that now. We've seen that for a while. Structural one. And may it last and may it help. But, just on a personal note, it's just great to see that the rise in Indian markets is not captured only by FIIs. Yeah. It's now being captured by domestic investors, which is just such music to the ears.
Also, I want to mention this because we talked about this before the show started. In October, this was the same fund house that put out a note saying that India would stand to be worst hit, along with Indonesia, on back of the geopolitical tension, on back of rising crude prices, a stronger dollar, and of course stress in Asia. We've waded through that and more in 3 months. So much so that the senior economist of the same fund house now is extremely optimistic on our country.
Modi is showing how she's ended it. But we need to end this straight setup piece here and move on to the editor's cut, because I think there is some interesting market link pieces that we have in the session today on editor's cut. Alex, what do we have?
Niraj, morning, and good morning to everybody tuning in as well. Just a quick heads up, if you're tuning into this particular segment of India Market Open for the first time, then this is meant to get you beyond the headlines. And today, in fact, we're talking about key data, as Niraj pointed out, that may suggest, and I'm saying this with a lot of caution, it may suggest that the uptick in mid-cap and small caps may just be in the last leg. Hiral is going to take you through some of that. At the same time, we're talking about PSU banks and why the uptick there is not necessarily over. In fact, it may just be starting based on the data that Niraj has gotten together. Hiral, let's start with that. Of course, the caveat is that you can not necessarily tell what is going to happen from here on out based on cycles in the past, but then history tends to repeat itself.
Absolutely. History does tend to repeat itself, because if you see the previous cycles in terms of the broader markets, what is coming out right now is, the key question is whether the mid-cap and the small-cap companies and index is probably in their last leg of the catch-up and outperformance that we've seen so far. Because clearly, if you go to see the 5-year outperformance as well as the 10-year outperformance, that is something which has been surpassed. Let's quickly look at the screens right now. If you see Nifty, we've seen a YTD growth of around 18% versus the 5-year and the 10-year, which was in that range of around 13 to 14%. Similarly, in terms of the mid-cap and small-cap, it's very interesting because your YTD is around 42 to 46%. Whereas if you see the 5-year annualized performance and the 10-year annualized performance, that's in that range of around 19 to 21%, right? So this is clearly telling you that right now there is that outperformance that has come in the first leg. Now, from here on, what are valuations suggesting to this? From a valuation perspective, and I want Niraj to come in on this one as well, clearly you've seen that the mid-cap valuation now is at a historical peak. And this is if you remove the COVID year, which is the 2021 year. The current for the mid-cap is around 24.2 times. 2017 peak was around 24.5 times, right? Similarly, small cap current is around 29.3 times, whereas the 2017 peak is 18.3 times. So one way the valuation has already surpassed the peak that we were looking at, and the outperformance has already come in. So that's going to be crucial from here on, whether for how long is this rally going to continue. The duration becomes absolutely important.
Absolutely. Niraj, do you want to come in on that valuation piece?
No, just that. So the small cap index valuation would be a factor of what everybody estimates it to be, but largely the numbers vary between 26, 27 times to 32 times. So let's say an average of maybe 30, let's say. Now, are these historical peaks? They certainly are, and therefore it's not a completely unwise piece to assume that we've gone to near frenzy levels, especially in the IPO markets and even in the mid-cap end of the market, and therefore the last leg of the rally at that end. The only question is, structurally, we are so strong that will dips be bought into? That's the question that comes in. But it's great, Alex. I think Hiral is done.
Absolutely.
This data working that Hiral and Jim have done is great.
In fact, there's more data. And I just a small point on this. I wonder, and we'll have to look at fund holding in the broader end of the spectrum. I wonder if the multiples that are currently being ascribed to the small cap space also to a certain extent has to do with the flow of retail money through mutual funds, and we're talking about participation through mutual funds of retail investors at a peak level never before. We're talking about 38,000 crore that has gone into actively managed small cap funds in the year to date.
So,
which is
one thing what I want to add over here is, if you see the trend of FIs as well as the DIIs in the mutual fund industry, the FI investments into small caps are weaning off. It's the retail and the DIs, the domestic players, who are increasing their flows as well in terms of the small cap funds, right?
Goes with the 38,000 crore
exactly.
number.
Yeah,
so it goes with that.
And the breadth of that, because at the broader end of the spectrum, you're talking about lower floats, you're talking about liquidity being an issue. So you're seeing fund managers go wider than they have in the past. So you kind of spread the wealth in that sense.
Yeah.
Let's
so
see
here,
that.
So what's the net call here? Sorry, Alex, you want to?
Yeah, no. So a little bit more data, and I'll quickly run through this. The average run over the last, and we're talking about 3-year cycles here. So 2021, 2017, and 2014, right? The average cycle, and let's pull that graphic up. Nifty 50 currently up 40.9% in the year to date. Mid cap and small cap around 73% and 77%. The average for the last several cycles is 62% for the Nifty 50, 88% for the mid cap index, around that same level for small cap index. But for the small cap index, we're already past the last cycle, and we're very close to the gain that you saw from trough to peak in the 2017 cycle.
But still away, right? Because
it's
the
still a
average
little
rise is
bit.
87
Yes.
and
Yeah,
currently
so
is
it's
77.
skewed just a little bit.
So, and that's the reason why that probably this is the last leg what probably investors could start
And
looking
the
at
very
this.
last
Really cool
element,
data, by the way.
very last element is the duration of the run from trough to peak, and the current run is 18 months, which is just higher than one of the last 3 cycles, and that was the cycle in 2013-14, which was 15 months. The 2018 to 21 cycle was as much as 43 months and the longest, and the one before that was 27 months. So from that perspective, there's still some ways to go, but then, like Hira is saying, last leg.
Yeah, sorry, 18 to, just one point, 18 to 21 is a bit debatable because it had a COVID period, and I think there was a very bad period for small caps in that period. But yeah, largely it seems 18 months is at par.
If you take the average also of around 28 months, we're still 10 months below the average. And if you, very quickly, if you just see the Nifty 50 stocks which are still below their 3-year and 5-year average PE, you have names like Dr. Reddy's, Apollo Hospitals, Bajaj Finance, HUL, UPL, and 4 banks, ICICI, HDFC, SBI and Kotak, right? So there are private banking names and PSU banking names, but that probably will take us to the second part of the piece as to what's happening with the banking counters.
Absolutely. And in fact, the data that you've put together, Niraj, on the PSU banking space, right? The recent run-up has kind of been driven by this pack, hasn't it? The question is, how far will it go?
Yeah, so actually it's not just the recent run-up. There is an index, and I'll make this quick now because I know people are waiting for the derivative segment, so we don't want to delay that. But from 2020 till 2023, a gauge of PSU banks index has beaten the performance of the private bank index, not by a country mile, but quite significantly. So PSU banks largely have done well, but they've seen a recent bit of a pullback aside of what happened yesterday. Now, the question that we are asking is, can PSU banks still continue to do well or bounce back from the hit that they took in Wednesday's session, right? Maybe we are doing this a day late. Maybe we should have done this yesterday because yesterday the banks did bounce back. The pluses, most PSBs are well capitalized. There's a strong earnings turnaround that we've seen in the PSU banks since FY21, late 2021 or thereabouts. The last 18 months have been very, very strong for the PSU banks. If you just look at the ROA uptake, if you just look at what they've done on the NIMs, on the PAT, etc., that has been very well, done very well too. Except maybe one, PNB, but most of this one are now above that 1% ROA mark as well, or around that 1% ROA mark, which is great. LCR is above the regulatory requirement, which is a great thing as well. The risk-weighted assets notwithstanding, I don't think it impacts too much. We don't have time to get into detail, but I don't think it impacts too much. But the other key point is that all of them have done a recent fundraise, maybe in some cases to comply with the regulatory framework.
And they have strengthened their balance sheet.
They have strengthened their balance sheet, done fundraise. Now this augurs very well if we believe that the capex cycle is going to start meaningfully. Government has happened, private capex will start. Who will lend? It's the
it has to
PSU
be the
banks.
So,
PSU
so the
banks.
post-election phase is going to be spectacular for these companies. And Niraj, you know, an SBI undervalued completely.
Still.
In fact, exactly. And you do. I mean, recently you have a lot of brokerages which are now clearly spotting it out, saying that our PSUs underrated, and is there a re-rating that could be on the cards?
Yeah, I mean, and you know, some would argue that Ramesh Damani, Samir also have played this very well, but maybe there is more in store. So that's a valid point. What, just very quickly, what ails the PSU banks? I mean, one, historical bias, because if you've seen the 2010, 2020 cycle, you'll be like, yeah, you know, we've seen this before, it'll falter. Maybe it won't. Right, so that is the one point, and the second point, there is a possibility that higher credit cost may impact the quantum of PAT growth going ahead as well. So that is to be kept in mind. Provisions are there, maybe they impact as well, and credit cost may impact. So that's one caveat to keep in mind. But the last point that I want to make on this is that if you just look at the divergence between what the PSU banks are saying and what the market is thinking of, the market in all the notes that, or largely the notes that you've seen, everybody's thinking of one, you know, the ROAs being about 1%, and the estimates are based on that. Banks largely are guiding for 1.2.
Yeah.
Right. So if they indeed achieve that
And overachieve, basically.
then there is an upside.
Small last point, small, very small, and we're talking about PSU so far, but we must remember that based on the current regulations, the engine of growth or lending growth for private sector banks, which has been on the retail side, might just get hit. And so from that context, if you want to participate in lenders, then where do you look?
Maybe PSU banks.
There you go. All right. So what do you think about the two topics that we've discussed today? Don't forget to write to us on any one of our social media platforms. As Niraj pointed out, we're going to go to derivatives really soon. So do stay tuned. Lots more coming up on NDTV Profit.
back. You're watching India Market Open. Let's take a look at the top headlines at this hour. U.S. equities gain overnight and are on the cusp of an 8-week winning streak, which will be the longest in the last 5 years. Third quarter GDP growth in the U.S. Estimates revised downwards to 4.9% from 5.2% earlier. That's ahead of crucial inflation data, which will come out today. Separately, jobless claims in the U.S. last week rise less than forecast. And oil prices slip as Angola leaves OPEC over production quota disputes. The Red Sea crisis has worsened. Container rates now surge as 150 vessels have diverted. And India is on the cusp of a takeoff, says Prime Minister Modi in a rare media interview to the Financial Times. He says, and I quote, "The people of India have very different aspirations from the ones they had 10 years back." Well, let's take a look at the Gift Nifty this morning, because the aspiration is that you're going to close out this week before a long weekend in a positive sense. And yes, you are looking at a benign but positive kind of open. No firecrackers there, but as it should be. What's happening on the F&O end? Agam is joining us for more.
Well, it does seem like we are finally moving into a week which is going to be all about holidays, because we're starting to see all traders take off their positions and perhaps relax, because that's what's pointing out or being pointed out when it comes to the index futures. So as far as your Nifty is concerned, an unwinding of nearly 8% in OI, even as we see the Nifty advance by around 0.5%. And that means that we are looking at a bout of short covering after the severe weakness that we saw in the session before that. It's the same when it comes to the Nifty Bank as well. Not too much to speak for, save for open interest decline by as much as 4% here as well. And we are looking at the Nifty Bank once again trying to inch back towards the mark of 48,000, currently just 200 points odd short. Now, what's happened with the Nifty options space for now, as you can see, maximum open interest in puts is at around the 21,000 mark, and maximum open interest when it comes to calls is at around 21,500. It's a 500-point range within which we are expecting the Nifty to move within. And, well, most likely we will also see a little bit of a moderation in your daily volumes through the course of the next truncated week. In terms of changes yesterday, naturally considering we saw the benchmarks move higher, we saw a little more writing around the puts. So we did see a little more writing around the 21,000, 21,100 puts. Not too much to speak for as far as calls are concerned, naturally, because we also saw the benchmarks move higher. In terms of stocks, we saw gains largely coming through. And in fact, as far as your open interest gainers are concerned, Coromandel, LTIM, GMR Airports, IRCTC, Shree Cement, all of them looking at longs building up. And save for something like a Bajaj Auto, which did see longs unwinding, we did see short covering in PI Industries, Aarti Industries, Eicher Motors, along with BHEL. Now, this is as far as your stocks are concerned. But what are our analysts and market experts making of these cues? And are they, in fact, also expecting about a consolidation? Let's get an expert opinion here. We have Amit Goel, a market expert who's joining us on the show right now. Amit, good morning and thanks for joining in. Let's start off with your view on the benchmarks. Are you also expecting consolidation to come through?
Very good morning to you, Agam, and thank you for having me on this show. First and foremost, let me wish you and your viewers a very Merry Christmas and a Happy New Year and Happy Holidays. Literally, Nifty has taken us on a roller coaster ride for the past 2 days with sharp intraday moves of about 400 to 500 points, and 21,000 has been defended quite smartly yesterday by the bulls, whereas the 21,500 and 600 levels seemed to be a near-term resistance from the bears' point of view. So I concur with your broad view that the market is likely to be in a consolidation range of about 500 to 600 points for the upcoming truncated week. Given this view, I could probably suggest that short-term traders could take advantage of this and the elevated IV levels to set up a short triangle or an iron condor with 21,000 and 21,600 as their levels.
Right. Okay, so Amit, let's talk about stocks then. And the first one on your radar is IndusInd Bank. You have a bullish stance on this one?
Yes, I do. So IndusInd Bank has been uptrending for the last nearly 1 year. And in spite of day before yesterday's fall, it has recovered pretty sharply and strongly yesterday. Given that it has taken support at around 1580 levels, 1540 levels, I would expect that the uptrend to continue in this counter. And given that the IV levels are pretty elevated, I would suggest we initiate a bull put spread strategy for the January expiry, because December does not have any many days left in the expiration cycle. I would suggest we sell the 1560 call and we buy an offset of 1580 call in the January expiry. The risk in this trade at stop loss of 1540 is about 2,000 rupees, and the reward at 5,000 yields a RR of 2.5:1.
Okay. That's as far as IndusInd Bank is concerned. But I believe to counter that, you also have a bearish view on Wipro.
Yeah, I'm trying to balance the views and give a long as well as a short trade to cater to all our traders. So Wipro is a bearish strategy here for me, because on the 75-minute time frame, if you notice from a pure chart price action point of view, we have a M pattern or a double top pattern getting formed, along with the break of the super trend green line confirms that there is some bearishness in this counter yet. Given this view and the low levels of implied volatility, the high levels of implied volatility, one can set up a credit strategy wherein we sell a 440 call and buy an offset of 450 call of the January expiry again, since December, as I told, does not have many days left in its expiration cycle. This view is negated if the price closes above the 450 levels, which is the pivot point, and the risk at 2,500 is on the stop loss level. The target is 5,000, so it gives us a healthy RR of 2:1 again.
All right, just to perhaps go ahead and simplify this view. Well, in this case, Amit, of course, has a bearish view. And what he's doing is that instead of buying a put, he's selling a call. If you sell a call, naturally, that you are looking at you're expecting the stock to move downwards or stay exactly where it is. But because of the fact that when you sell a call, your theoretical risk is unlimited, you're going to go ahead and also buy a higher level call so as to have a limited risk in this case, and that is where you have this credit spread coming through, and that's exactly what Amit is deploying as far as Wipro is concerned. Amit, if I'm not mistaken, is that what the thought process is here as well?
Absolutely, Agam. I completely agree with you. Very well said.
Right. Okay. So fair enough. So Amit, we leave it at that. Thank you so much for joining us and taking us through your views on Wipro as well as IndusInd Bank. We'll continue to keep an eye on that one. Happy holidays to you as well. And with that, it's over to you, Samina.
You still have the rest of the day to go, Agam. But happy holidays nevertheless. The markets, the GIFT Nifty is indicating to a flat to positive start. We've got with us Amnish Aggarwal of Prabhudas Leeladhar retail sector, and Aditya Aggarwal, head of research and investments of Invest for Edu, joining in. Aditya, good morning. Thanks for joining us. Aditya, what are you making of that very sharp downward move which we saw day before yesterday? Of course, what we also saw yesterday was a very sharp and smart recovery that happened in the second half of trade. Very clearly, any sort of weakness is getting bought into for now. Are you anticipating the rest of the month to be all about consolidation, or would you be a buyer on every dip?
Hi, Samira. Good morning. Thanks for having the show. I believe market is still in a momentum wherein the trend is still going very strong, to be honest. Look at the way markets pulled back in trade yesterday, and especially led by the banking stocks. Bank Nifty almost recouped the entire loss of the previous trading session. If I take a look at deeper into the chart structure, Nifty has actually formed a positive reversal with respect to RSI. And that tells me that if the buying continues in today's trading session, I won't be surprised if the previous high, which was somewhere around 21,500, will be taken out next week as well. So I believe markets are getting bought at lower levels, definitely. Volatility will remain because if we take a look at VIX, that has started to spike up despite the fact that markets have inched higher in the last few trading sessions, barring that one day when markets corrected sharply. So at the moment, I'm not too bearish, Samira, to be honest, on the markets. If anything, I look to buy any decline on the Nifty and on the bank Nifty especially. And I believe once the market starts to sustain above 21,300, 21,350 levels, market could easily test levels of 21,500 in the near term. On the downside, again, 21,200, 100 continues to remain a strong support area. And if anything, I would bet on the bank Nifty because clearly the rally is taken by the banking stocks, and HDFC Bank has given a clean breakout on charts after months of consolidation, Samira. So I believe it's time HDFC Bank and Kotak Bank both take leadership, and you can see decent upmove in both the banking stocks.
Aditya, if we do get an opening around 47,800, 900 on Bank Nifty, would you initiate a fresh long? Is that a fair assumption?
Yes, definitely, Samira, because I believe banking stocks will cross, Bank Nifty rather, will cross 48,000 levels. And I wouldn't be surprised if we see levels of 48,200, maybe not today. Next week, definitely, I believe if Bank Nifty could test levels of 48,200.
Good morning, Amnish, Tamanna here. Just keen to know your thoughts on how you are looking at the day today ahead of at least a long weekend coming in. Is this the day to sit on the sidelines or look at very specific kind of opportunities?
The market reacted sharply day before, and yesterday was a pullback given the fact that we have a long holiday and the year end, you can say, ahead during the next week. I think next 2 to 3 sessions are very important because we had a very, you can say, a sharp dip on Wednesday, and the sort of reaction which market gave on that day, that came after a long time. So very difficult to say that whether we are, you can say, through the trough already. Okay, I at least don't rule out that now the action will become much more stock specific and large cap focused, although there has been some sort of a bounce back which has come in many of these, you can say, mid cap, small caps yesterday. So I think one can continue investing very selectively, but definitely it has to be very stock specific approach, and one just can't continue picking up, you can say, stocks with bloated valuations or where there is too much of froth in the market.
Amnish, Aditya, stay on with us. I'm bringing in Himansh Kaval, my colleague on the research desk, who is putting together a list of stocks that are buzzing today with a lot of news flow. Yes, Himansh, what's on your list?
Thank you. So the 3 counters that I'm eyeing out for today, firstly is Goel. The company informed of its production numbers for the calendar year to date up to December 20. Production has surpassed 16 lakh tons. Now, this is 26% higher from its previous best that it clocked pre-COVID, which is 2019. If I refer to the sales numbers that are posted for the month of November, sales exceeded 14 lakh tons, proving the previous best back in 2007. So, which is very significant for a company like Goel, because if you go back to see last week, it entered into a joint venture agreement for 51-49 partnership with GMDC for manganese ore mining in the state of Gujarat. And the company has also given an added thrust towards expansion, exploration, doubling down on the kind of core drilling it has been undertaking over its land parcels. Second is Tata Motors. The company has received a no objection certificate from the exchanges for its DVRs that are set to be converted to ordinary shares. The shareholders will receive 7 ordinary shares for 10 they'll receive 7 ordinary shares for 10 DVRs held. Now, the last time you saw the board announcement coming in, you saw DVRs jump 17%. So some bit of action may be coming in here today as well. And lastly, UPL, where the manufacturer of agrochemicals has been proposing and considering a fundraise in the near term. So you might see some action coming in from there as well.
Thank you for that, Himansh, talking about some of the buzzing counters today. Let me go across to Aditya very quickly. Aditya, I just want to know your top ideas, top picks for the day before we move ahead.
So I've got a couple of buy recommendations, Tamanna, because I believe market still has some juice left, and today we could see a continuation of the follow-up of move that we had seen yesterday. So the first stock on my radar is Reliance Industries. Has been one of the very strong stocks in the entire volatility that we have seen in the near term. So Reliance is a buy for me. Looking at a target of 2,800 with a stop loss at 2,450 on the downside. It's more of a positional trade, Tamanna. So I would want to buy and hold the stock because it's a very strong looking chart structure for Reliance at the moment. The second has to be from a pharma pick because pharma has come back, both the diagnostic space, hospitals, and the pharma space. So I picked up Aurobindo Pharma, which is clearly broken out from a consolidation phase and has entered into a new all-time high territory. I would look to buy the stock at current levels, even on declines, for a target of 1150 on the upside with a stop loss at 1050 on the downside.
So, well, thanks for that, Aditya. Now, Himansh presented a set of stocks in news. One of them is UPL. Interesting that they're doing a fundraise meet. And Amnish, I would want to come to you on this. It seems that all kinds of fundraisers, QIPs, block deals, what have you, are getting executed with a snap of the fingers, right? Now, my question is, here's a UPL in a sector which might show stronger growth in the second half relative to first half, but company after company on the global side in this agrochem space has voiced concerns for the near term at the very least. What would you do if you were given a chance to participate in the block deal in this UPL? Would you subscribe at a small discount, or would you stay away from this bucket because there are other pockets to invest in?
If you look at, say, last 12 months or so, the agrochemical space in general, it has not done well fundamentally because of the pricing issue, because of the demand issue, not only in India, but even globally. And UPL is I would say, is a global play. It's not only an India play. So now looking at, you see, today the market is such that there's a lot of money sitting on the fences, a lot of news flow is there. But definitely, having said that, many of these, whether it is QIPs or preferential issues, they're actually going at a discount to the market. I think hardly there would be anything which is going at a premium or at par. So there is a likelihood that even this issue might go at certain set of discount. But having said that, agrochem is not a space which is, I would say, it's in the flavor or where there is a very great visibility, at least in the near to medium term. So it will all depend upon the pricing and what are the plans of the company. If they are planning a fundraise, whether it is debt reduction, whether it is, you can say, some sort of expansion or acquisitions. It all depends on what sort of a plan they present if they are doing a fundraise. So you can say, putting money in this stock will be a function of that.
Aditya, Amnish, stay with us. While we've said there are so many stocks to watch out for, some news-driven and some on back of brokerage calls. We've got a bunch of them. We've highlighted a few of them, but we'll continue doing that over the next couple of seconds. A quick one on Siemens. You had a buy call from Jefferies where they've raised the price target on the counter by nearly 28%. So this is an important one. But you also have Motilal Oswal that has reiterated its buy call with a price target of 4,600 rupees. I'm not sure what it's been raised from, but nevertheless, they've reiterated that buy call on the segment. The energy segment demerger is possibly expected to kick off in by 2025, and that is the biggest positive that both brokerages are viewing on Siemens. The stock will be one in focus. It's actually had a pretty good run so far in the month of December. If you can look at it for the last 1 week, it'll be interesting to see how it's played out. For the month, it's up nearly 12% on the stock. So Siemens is one. Niraj, Tamanna, this is one counter which will see some activity in early trade this morning for sure on back of two big brokerage calls and the fact that it's been on the radar of a lot of traders over the last few weeks as well.
Has done very well in the last 1 month too, and Cap Goods is right in that space.
It's the right theme.
Yeah, let's ask our guests about it as well, both fundamental and technical. Amnish, to you first. I don't know if I have an individual view on Siemens, but if not Siemens, then this whole space, ABB, L&T, Siemens, all of them have done well. But Siemens in particular, because everybody has gone ahead, raised the targets there. Fundamentally, how does it look?
The reason Siemens has done better in comparison to ABB and others over the past month or so is that the stock had corrected earlier from 4,000 to a level of nearly 3,400 when the deal to sell their drives business that didn't materialize. Now, going by what has transpired in the, you can say, analyst meet yesterday, I think the growth outlook for the company remains extremely strong, whether it is transmission business, whether it is a locomotive order which they have got, which will be executed over the next 8 to 10 years, or whether it is, you can say, the the various, you can say, equipment or various, you can say, the tech stacks which are related to cyber security, automation, and all that stuff. So I think the way the entire, you can say, the entire manufacturing as well as your infrastructure is moving towards more of automation, more of, you can say, smart infra and all. I think Siemens is one of the companies globally which has always been on the forefront when it comes to developing the technology. So I think given the fact that there is a probability of demerger in this company, which the parent company is now looking at in 2025, and the order inflow even in the demerged Siemens Energy is likely to be strong on the back of, you can say, expected increase in the T&D spending, I think the stock should do well over the medium to long term. When it comes to, say, the entire basket, Siemens, ABB, L&T, I think these companies are not actually comparable to each other. ABB is now more short cycle driven company, and L&T is more like play on the infra segment and not some of the automation stuff which these two companies are doing. But given the fact that India is one of the largest markets globally and it is fast growing, and there's a lot of emphasis on development of infrastructure, even though the private capex is yet to pick up. So that is a silver lining, that if that picks up, there could be further increase in the growth rates of these companies. So I think we are positive on all the three, and given the fact that I think the way value creation has happened for shareholders during the merger of ABB 3-4 years back, I think significant value creation is expected in the Siemens over the next couple of years. But I think these all stocks, they are first of all not cheap, and secondly they are not, one should invest in them from, say, the next couple of years viewpoint, and just not for the next, say, month or 2 month or 3 months view.
I think that's a very important point, because if you're buying it, don't buy it from a short-term perspective, because these are expensive. However, if you're a trader, what should you do? Aditya, good morning. Niraj here. Very quick view, 30 seconds if you can. Siemens on the charts.
Morning, Niraj. It's a bullish looking chart. If it starts to trade above 4,000 level, I'll be a buyer here with a stop loss at 3,900, and I'm looking at a target of 4,400. It's a very strong looking chart, Niraj, and the indicators are also supporting the same.
Keep in mind, technicals and fundamentals for the short term may differ, so both of them are right in their own way. Let's see if they are. The stock price this morning will tell us. We'll slip into a very quick break, back with the pre-open session.
watching the India market open. Just a few seconds to go for the pre-open session, and we'll see how the markets open. And while we keep an eye on that, let's just take a look at some interesting notes out this morning, and especially the one on Embassy Office Parks REIT. So a lot of news flow on this company. Blackstone exited its 24% stake just a couple of days ago, and Morgan Stanley has maintained an overweight on the stock with a 370 rupee target price on Embassy REITs. They in fact have said it's a good thing that the free float has increased from 69% to 92% because of that exit as well, and it's removed the biggest overhang on the stock. We'll go across to our experts as well for their view on Embassy REITs and whether they think it's a good buy. But just quickly, very quickly, let's look at the pre-market open and the pre-open rates settling in as we see. Let them settle in. The first couple of seconds can be a bit confusing, but all in all, we are all set for a positive day of trade. Will there be fireworks? Possibly not. Possibly not is what we can say at this point, as people are winding down positions ahead of a long weekend. No one might want to be stuck out on a limb with 3 days of news building in and no opportunity to react. So that's what we might see. We'll come back to those pre-open rates in just a bit. But I want to go to Amnish and Aditya on Embassy REITs, which is an interesting play. So Morgan Stanley also says that they expect revenues to rise 14% if their EOP reaches their peak of 95% versus 83% currently. Amnish, I'll come to you first. Any views on Embassy?
You see, we don't have any coverage on this, but having said that, I think there's a robust demand for the office, office space in the past 6 months to a year. And if the trend continues, then Embassy, being the largest player, should benefit from it. Other than this, I think we don't have any, firm view on the, these real estate REITs.
Aditya, do you track this one at all? Embassy REITs, anything on the charts that could be worth a trade?
It's all over the place, Samira, to be honest. If you take a look at the chart structure, too many gyrations between high and low. But looks like it's forming a bottom for sure at current levels. Can test levels of 400, 450 with a good support at 300. So the risk to reward is suggesting that one can actually look at Embassy REITs. If they have the appetite and the risk-taking ability, then definitely they can look at it. But 300 is a good strong support. That should be a stop loss.
While we've been talking about brokerage calls, there's also one more from Morgan Stanley on Bajaj Finance. They rate the counter an overweight with a price target of 10,000 rupees. So about 30% or 25 to 30% upside from yesterday's close is where they've raised the target of Bajaj Finance to. They have said that they are waiting commentary from the company to understand probability and extent of recoverability. This could translate into 1.7% to 1.3% of FY24 and FY25 earnings respectively. Well, they've also said that the SATs quashing SBI's order on Karvi, lenders to be paid their dues with interest. So that being the biggest positive trigger on Bajaj Finance, 28 to 30% upside is what Morgan Stanley is expecting on Bajaj Finance. On the charts, Aditya, Bajaj Finance, 10,000. Currently, we're seeing, it's trading around 7,400 odd. Next stop on Bajaj Finance. Fundamentally, of course, I'll talk to Amnish, but technically, how does this one look? How many supports and resistance to get to those levels, and the kind of timeline we'll be looking at on the charts?
The timeline has to be slightly larger, Samira, because it's a sideways consolidation stock, hasn't done much for itself. If you take a look at past couple of months, it has actually been very narrowed sideways consolidation. On the upside, 7,800 is a very important, crucial support level. If that is taken out, then yes, I'll be a buyer in the stock because it's due for a big up move. On the downside, 6,800 to about 7,000, these are two very strong support levels. If I'm going to go long on the stock, I will wait for the stock to actually cross levels of 7,800. Then I get a good breakout on the upside, and then my first target would be around 8,100, about 8,200, and on the downside support will be around 7,300 for the breakout. I'll wait it out, Samira. I'll not be in a hurry to go long on Bajaj Finance just yet.
Amnish, while technically Aditya is not going to be in a rush to go out and buy Bajaj Finance, what are you doing with it? Is it a stock that looks good Is it? Are you taking heart from the fact that there have been a few brokerage upgrades? 30% higher upside is what Morgan Stanley is calling it on Bajaj Finance.
You see, Bajaj Finance has been most expensive NBFC of the financial stock in the recent times. And this is because they have been growing much ahead of the market growth. So I'm not a very big fan of buying, say, any financial at 5, 6, 7 times price to book simply because the growth rate is higher. Because in the longer term, the price to book value has to converge to the mean. We have seen it happening in banks, even HDFC banks, at Kotak. All these, they have seen their price to book come off over a period of time. However, if you look at, say, last 12 to 18 months, the stock really hasn't done much. It went down to, I think, close to 6,000, and after that, it has recovered. So, yes, in the near to medium term, the stock can give you, say, 15 to 20% return from here. But in the longer term, one needs to look at what could be the price to book, say, 3-4 years down the line. Because in the longer term, sustaining these price to book of 7 times, 8 times, and then giving these lofty target, that needs to be taken seriously. Because as has happened with most of the other financials, I think over a period of time, Bajaj Finance will also settle at the price to book value, which is lower than what it is currently trading at.
I want to talk a bit about LIC. That's also a significant story that we're following right here on NDTV Profit, and important to understand what the stock response is going to be. So the Department of Economic Affairs has given a one-time exemption to LIC. The rule is that every listed company has to achieve a 25% minimum public shareholding threshold. But LIC has been given that exception for 10 years. So the next they have to do that is 2032. Will it be a big boost for the stock? What does it mean for shareholders is an important conversation that we require to have. Look at LIC in pre-open as well. But I'm going to come to Amnish for this. Amnish, view on LIC, and does this come as a big sigh of relief for the company, for the insurer?
Yeah, sure. Because the main thing is that if the company has to dilute the stake, say the promoter stake has to come down to 75% over the, say, near to medium term, then definitely there is an overhang on the stock, because the float will continue coming into the market from time to time, and that will keep a pressure on the stock. So, and given the fact that it has been given for 10 years, I think it is all the more important. And this is also, I think, important because usually for you can say institution like LIC, usually there are a lot of rumors that LIC now is privatized and all that. So I think it will give a lot of elbow room for the company to adjust to the market realities, and also for the investors as well as the you can say as well as the entire investing community. Now, as far as your stock is concerned, I think LIC remains a formidable player. The private sector has come, they have increased their market share over a period of time. But I think LIC will continue to be the main driver of this. And given the fact that now the overhang on the fresh, you can say, float coming in has gone down, so it will definitely provide some near-term boost to the stock price.
Aditya, just a quick view from you on LIC.
It's a very interesting looking chart.
Yeah.
Yes, it's a very interesting looking chart, Tamanna, because look at the way the past few trading sessions the stock has run up, and it was on extremely healthy volumes. And the recent correction hasn't been encountered on huge volumes. So it tells me that the buying which we had seen in the past few weeks, buyers are still there. And people are not looking to book out profits just yet. And it's broken out from a very long consolidation phase. So I believe, and the recent low also happened to the previous peak. So it's a very strong looking chart, Tamanna. I would be a buyer in LIC, to be honest, with a caveat that I might have some personal holding here. But the chart is looking very strong. On the downside, 740 is a very strong support. Immediate target will be 820. And if that is taken out, I won't be surprised the stock actually nears 900, which was its listing all-time highs.
Needs this, frankly. I mean, insurance companies need this because they've really not given any kind of returns. We've done a small piece on the editor's cut some time back, which showed these PSU insurers, even after the run-up that they've done since listing mid-2021, have hardly delivered returns. So it's good that this overhang goes away. In some sense, the fundamental performance of LIC, which has picked up a little bit in the recent past, might just bring some more legs to it. So let's wait and watch.
I just have one more aspect to add. When LIC was listed, the question always was that will LIC run like a a company which is focused on profits? Will it run how a stock market investor would expect it to? And will it continue to get those exemptions from the government? The 10-year exemption is in national interest. I think that's important to note, because the performance of LIC, whenever it's looked at, will be looked at also with the fact that the government will continue to remain the largest shareholder for the foreseeable future.
Yeah, that goes without saying.
The government has its back.
Yeah, but that would be there with 75% as well, independent of whether the dilution is going to. But just the fact that the overhang goes away, as Amnish said, should be construed positive, and I think that's what maybe the market is showing right now.
Today, the market invariably will give a thumbs up to most semi-positive news flows as well. But nevertheless, LIC has done a very sharp recovery, like Tamanna, Niraj, Aditya and Amnish both all have indicated. The stock has recovered nearly 27% from November. So worth taking a note of. The stock closed closer to around 800 odd levels. It had taken a massive beating and made a low early this year to levels of 530 apiece. This was a sharp fall that the stock had seen from its highs of 950. So some relief. We could see a little bit of a Actually, that's a pretty sharp reaction coming in. I think, Niraj, I might have to agree with you on this one. There is
no, we have to agree with Amnish.
We have to agree with Amnish. Yes, Amnish, good point there. Aditya, but even at 807, I mean, this is a pretty beautiful gap up. If this plays out as pre-open is indicating too, what do? Jump in, maybe intraday call on the stock?
Samina, I would wait for an intraday move, maybe 15 minutes. I'll observe how markets or maybe the stock is behaving in the first 15 minutes post-opening. If the gains are held, I would be a buyer in the stock, no doubt about that. And I will look for a first target of 850 and then maybe 880 on the upside with a good strong support at the lower end of the gap, maybe around 800. And if that is broken, is 760. On the flip side, if the stock starts to cover up the gap, I will wait out. If it takes support at previous day's closing, then again, I'll be a buyer in the stock because clearly it's a upward trending stock, and I would look to buy a stock which is trending higher on declines rather than be a seller in the stock.
Amnish, Reliance Industries, have you been keeping an eye out on this one after 3 years of underperformance? We've seen some interest on the stock in the last couple of days, or if not weeks. What are you doing with RIL? Any sort of investment call here for the medium term?
You see, RIL to me looks an interesting stock because over the years, if you look at the value of the company today, the large part of the overall, you can say SOTP is coming from, one is retail, second is Geo. And going forward, the way the company has plans both on the, you can say the new energy, both on the, you can say emerging technologies, I think that is where a lot of value is likely to be created over a period of time. For example, if you exclude the Geo Financial, which has got, you can say, demerged, even after that, the returns over the last couple of years have not been that significant. So my sense is that the way this company is now moving, it is creating new verticals of growth. And as when these mature, because today market is perhaps not assigning any value to all the new initiatives. So once they start assigning to the value to the new initiatives, like it has happened in your retail, it has happened in Geo, I think we will see, you can say, certain leg up coming for Reliance. And for the next, I would say, couple of years investment, I think the stock really looks good, and it should, I think over the next 1 year or so, it should give you 15 to 20% returns. Because it has been nearly 3 years after the first wave of COVID, the stock is practically, it has not gone anywhere.
Right. I just want to quickly, we just have about 2 minutes to open. But before that, I just want to quickly talk about this HSBC report on India credit cards. They have said that total card spending is up 40% year on year in November, though it's down 10% month on month from a high base. In October, maybe pre-festive sales. Cards in force have grown 1.4% month on month, and HDFC Bank, ICICI account for 41% of net cards issued. They say HDFC and ICICI have gained market share, and IIB actually have gained market share, while ICICI Bank, Axis and SBI cards have lost share. Just very quickly, Amnish, briefly, any view on SBI cards, Axis, HDFC? Are you tracking this kind of spend at all? But very briefly, please.
Okay, you see, we do keep track of these your spends on credit cards, and they are clearly a reflection that the middle class spending or the upper middle class spending is coming back. So don't have any, you can say, firm view on the SBI cards per se, but definitely these spends are a very good reflection of the way you can say the consumer spending is panning out, and also the regularization of the economy which is happening.
Okay, Amnish, thanks for that quick answer. We'll come back. Would love to take final calls from Amnish as well. But Aditya, we've taken your top calls. If I can peg you 20 seconds, give me your one top call for this morning.
Niraj, it has to be Aurobindo Pharma because of the way that it broke out in yesterday's trading session. I'll go with Aurobindo Pharma with a target of 1150.
Okay, Aurobindo Pharma is Aditya Agarwala's top call for the day today. Watch out for this. We'll get a fundamental investment idea from Amnish once we just mark the open before thanking him. But here's just 15 seconds left for the markets to kickstart trade. Keep in mind, a clutch of individual names are doing very well. Tech seems to be starting off okay. There are pockets like LIC, All Cargo, Ami Organics, etc., which are doing well. So that's to be watched out for as well. But here are the first trades on this Friday morning. About 0.25% for the Nifty and the Sensex, just about meandering along. Banks are flattish, so not going as well. And maybe, which is why I was saying that IT is probably done well. But the main part is mid caps and small caps. 0.5% up for the mid cap index. Let's get the small cap index up on the screen. 0.71%. Strong start at the broader end of the spectrum. I think this is the key thing. Now, bring up the heat map and show you what's happening. There's no point in looking at an advanced decline so soon because there won't be a chart formation. But suffice to say, the number of advances would be much higher than the number of declines on open. And it's showing in the Nifty as well. Just about 8 stocks in the red, with the top loser being Infi down about 0.5%. And that's the mood, that no stock is down even more than 1%. But even on the gaining side, Adani Ports, UBS has a note out there with a target price of 1175. Maybe that is egging the stock higher, though they're saying that the upsides are capped. But LTI, Adani Enterprises, Hindalco and Tata Motors bring up the other gainers. So no great gainers either. There's just 2 stocks which are above 1%, which is Adani Ports and Hindalco. Are we seeing a trend in any of the sectors? No, Infi is down while the rest of the IT stocks like HCL Tech, LTI Mindtree, etc. are doing well. So bit of a divergence there. Some strength in NTPC, ONGC. Remember, upstream oil was very active yesterday, but oil has taken a bit of a backseat, and which is why we're not seeing dramatic gains in an ONGC or Oil India maybe, which was the big winner of trade yesterday. But suffice to say, when you look at the large caps, the only one worth talking about is Adani Ports, with now a gain of close to 2%. So strong start for that one. Adani Enterprises giving it a little bit of company, but clearly IT and Adani Port, the only ones worth talking about. Clearly the action, Tamanna, at the broader end of the spectrum.
You know, for all the bad rep that small cap and mid cap stocks have been getting in the last couple of days, with a lot of experts saying that it's an overheated space, etc., this is where you're seeing most of the action firing through. I just want to pull up a few counters. Let's start with LIC. LIC, we've been talking about it in pre-open as well. A huge boost is what that stock has got. Just look at that. 7% up on trade this morning. LIC, you're seeing a big jump up over there. What's happened is that they've got a 10-year reprieve to bring down their shareholding from the government and increase their public shareholding actually to 25%. Ami Organics, let's pull up Ami Organics. A whole host of news coming in. The Chovatia family is offloaded 12% stake in the company. The promoter holding has also dropped that stock up 5%. They were anyway up yesterday on a big Gujarat government MOU that the company had signed. GMR Airports is the other one that is on our watch list this morning. That's also doing fairly well, 3% up. The NIIF is going to invest 675 crores in the company's upcoming greenfield airport at Bhogapuram. And this is the second investment of this NIF in a GMR airport after the Goa International one, which is up and running. Zomato, just Zomato, because there was a clarification that came in from Deepinder Goel, who doesn't rarely speak on market speculation, but he chose to come out and talk about it and said, no, we're not buying Shiprocket. That stock about 1.5%. Maybe that's also going into a holiday break season when people want to indulge and order more food. I'm not too sure. Just Embassy REITs, because a Morgan Stanley note with a boost to the target price, but not doing anything much for them. Embassy REITs is responding negatively, down about 1.5% in open trade. And again, Bajaj Finance, Morgan Stanley has set a price target of $1,000 for Bajaj Finance. It's tepid, to say the least, in trade. I'll just talk about Jefferies' note on Siemens. So just let's look at Siemens. We've been talking about that in pre-open as well. All right, 3% up right now. And Mahanagar Gas is the last one that I'll look at. That also had a positive Jefferies note this morning. And that stock is showing some signs of life, but not too much action. But are there any sizzlers out there, Samina, or a bit of a tepid mood?
There are a few other movers as well. So take a look at All Cargo Logistics, All Cargo Gati. We mentioned this in trade setup this morning. What All Cargo Logistics has done is they've demerged their export business. So there'll be a new company that will be listed, and they've merged their domestic business, which is All Cargo Gati, into All Cargo Logistics. On back of that, Gati is up 6.5%, and All Cargo Logistics is seeing a move of 7.5%, almost 8% now. So those are the two big movers moving on large volumes in the broader markets this morning. KPI Green, this news came out yesterday, but the stock is continuing to see some buying on KPI Green. Okay, it's off the day's high point, but was trading with a gain of 1% on a QIP for 1245 rupees. Tata Motors DVR, they've got the approval to convert their DVR into voting shares, on back of which the stock is up about 1.5%. The other few names that are looking good, Prestige Estates is trading firm, up about 4% on Prestige this morning. GMR Infra is up nearly 3%. Phoenix, Supreme Industries are some of the other counters. GMR is up 2.5%. V-Guard is looking good. Z continues its rally from yesterday, so there's some sort of buying coming in there as well. On the sell side, I'll quickly pull out a few names that are seeing some pressure building up. Just on the front line, you've got a few. In fact, I like it in Inox India. It had quite a stellar listing yesterday. The stock has been a talking point for some time now. Not bad. It's still trading with a 1% gain this morning, so some amount of consolidation is what we are picking up on. If I can just quickly get the list of top losers in trade right now, it should be helpful for our viewers to understand what the trend of the market is. So VBL is looking weak, Polycab, Mastech, 361 is trading positive, but IFL on the other hand is seeing a cut of nearly 1%. Apart from that, you have a few other names that are trading slightly weaker. So you've got Indotech, Unitech, largely in the broader market space. The markets, in the meantime, consolidating. The breadth clearly is slightly on the lower side as we see it. Couple of others, there is activity, but it's largely stock specific, and that's what we are picking up in early minutes of trade. Well, we've got Aditya and Amnish still with us. We'll continue talking to them about what they feel about the way the markets are looking. Aditya, what are you making of the opening this morning? Any trade on Nifty or Bank Nifty?
It's absolutely flat. Samina, I will not go long on the market, especially Nifty, till the time it sustains above 21,350. If it does so, then maybe I'll look for a long trade. Same holds true for Bank Nifty. I'll just wait it out for some more time and see how the markets behave. If Bank Nifty starts to trade above levels of 47,900, then I'll go long on Bank Nifty as well. But it's not a bad looking start. It's more of a flattish start for the markets. I will just wait it out. There are action clearly in the stocks, so I will stick to stock specific buying it there.
Amnish, before we thank you, overheated markets to some people, but you have to advise clients about what to do. If I ask you, what is amongst the highest conviction ideas from an investment perspective for the next 1-2 years? What is it that you would have recommended? The first amongst equals.
Some of the stocks we are very positive about. One of them is, which we discussed today, Siemens India. So we have been very positive on this. Then RR Cable is another stock which got listed, say, 3-4 months back. So that's also an interesting company. In the healthcare space, Max Healthcare is there, and then Cipla is there. On the consumer and retail, we have been very positive on Avenue Supermart. So I think broadly these are, you can say, some of the names which we have been very positive about and we have been recommending to the clients.
The valuations of Avenue don't deter you, Amnish? I mean, I know you track this space very, very closely. Why an Avenue? Why not a Trent? Why not some of the others?
See, Trent is also good, but Avenue, you see, from the last couple of years, the stock has not done anything. It is under a lot of pressure. But my sense is that the worst in terms of the margin pressure is more or less over. because the hit they've got in apparel business from the likes of Zudio, Reliance, so that is more or less now priced in the margins. Some of the parameters like sales per square feet or sales per store, I think last quarter, after a gap of say 5 to 6 quarters, they are now also trending in the positive territory. So the way I'm looking at it, I think from this quarter onwards, I think the company should be back to good amount of profitable growth. So it's again not a stock which is cheap or which will give you say very electrifying returns, but the space is fairly consolidated and even their online DMart ready is doing well. So in the long term, I think from the investment viewpoint, the stock looks interesting on any decline.
Amnish, thank you so much for joining us today on the show. Let's take a look at how markets are setting up. Yes, not a firecracker kind of a day, but definitely not negative. Just want to bring your attention to the realty space, doing fairly well. In today's trade, the Nifty realty is up, and counters like Phoenix, Mills, Prestige, Brigade, all showing decent pops in trade today, all apart from Godrej Properties. But yeah, Phoenix Mills looking fairly good. Any views on this space, Aditya? Phoenix Mills, are you tracking it?
Not really, Tamanna. Phoenix Mills in particular, but yes, the entire space is looking very strong, and I've been a strong buyer in most of these real estate counters. If I have to pick one, maybe Oberoi Realty definitely stands out, and Brigade Enterprises, both these stocks stand out. On an Oberoi Realty, I'm looking for a target of 1550, 1600. On a Brigade Enterprise, I'm looking at a target of 950 to about 1000 rupees. So both the stocks are would be the top bets from the real estate space. And if I have to pick a large cap, DLF has to stand out because clearly it's in a strong uptrend.
Right. Just very, very quickly, if I can quickly get a word in, Aditya, from you. I know we're short of time, but do you track all cargo logistics and all cargo Gati at all?
Samina, not really. I can take a look at Alcargo Logistics. Okay. So the stock is showing a resistance around 315, 316 odd levels. If these levels are taken out decisively in trade today, then I would look to go long because that happens to be a major resistance for the stock. If it doesn't cross 316 in trade today, then there's a case stock can see some bit of profit booking, and then I look to go long on the stock. At current levels, I'll just wait it out.
Aditya, Amnish, thanks a ton for joining us this morning. The markets are trading flat. It is going to be a morning of consolidation. But one counter that's catching our attention is Ami Organics. If you can get that one on the screen, it should help our viewers understand why we're talking about this. It's about 5% higher. So it is at the day's high point, closer to levels of 1200 on it. We have Varsha who's standing by with more on that. Varsha, there was a pretty large block deal that took place yesterday where 12% equity changed hands. Even then, the stock managed to go with a gain of 5%. It's building on those gains with a gain of 5.5%, 6% as we speak. What's the update? Who's sold what and who's bought what? And of course, a quick sense and outlook.
So, as you rightly said, so stock is up 5% and a 12% equity change hands yesterday. So, the buyers were, so let's see who the sellers were. So, the sellers were 3 ex-promoters now under public shareholders. Now, they offloaded share of rupees 740 crore. Now, if you see, Chovatia family, they held almost 17% stake in the company, and Girish Kumar Chovatia sold almost 5% of their stake, followed by Kiran Bain and Dhwani Chovatia. Now, if you see the buyers for this transaction, now this is one of the reasons why the stock has been gaining up. So, Morgan Stanley has bought almost 2% of the stake, followed by BofA Securities and ICICI Prudential. Also, if you see Malabar India Fund, Value Quest and Goldman Sachs were the other buyers. Now, Malabar India already hold almost 1.89% stake in the company. Now, they have additional bought the shares. Now, if you see the fundamental aspects to this, there are a lot of growth triggers when it comes to Ami Organics. So, first one being the deal in the Fermion contract that they have. So, they've already signed 2 pharmaceutical intermediate agreement with the company. Now this is a multi-billion, multi-year deal for the company, and FY25 will be very significant growth from this deal. Now if you see also they are also entering into electrolyte business. So yesterday this was the news that company has signed MOU with global manufacturer of electrolytes. Now this MOU is with government of Gujarat for investment of 300 crores. Now if you see, this is for setting up dedicated manufacturing facility for electrolyte business. Now also company is entering into semiconductor business. Now this is through acquisition of Baba Chemicals. So the Baba Chemicals has a strong position when it comes to photo-resistant chemicals. And if you see the guidance for the company, so Q2 FY24 for the company was not good. Now this was led by a very weak export, which is a high margin business. So if you see the margin for the company, last year margin was 19% versus 14% this year. Now this was led by low export intake by the company, and again also the company has also revised its guidance from 22 to 25% to 18 to 22%. Now this is on the back of the problems, the China dumping that we are seeing in the specialty chemical business. Now going ahead, if you see FY24 may be muted or degrowth for the company, but FY25 will be very good for the company on back of the large deals, the large contracts that we have seen for the company.
Varsha, so just very quickly, you dwelt on the fundamentals already, but amongst all the recent developments that have happened in AMI, which is the one that analysts are saying has the most significance?
So Fermion would be a really good deal for the company, because this is a multi-million, multi-year deal for the company. So already company in November, if I'm not wrong, in November 22 and September 23, they had already signed agreement with Fermion for 2 of their intermediate business. Now for that products we need raw material also. So AMI has recently signed for deal with Fermion for the raw material of the earlier signed contract. So almost 4 pharmaceutical intermediate AMI will be preparing for the Fermion business. So this will be very significant number in FY25.
Varsha, thanks for putting this into perspective. Now viewers, just let's pull up the AMI Organics 1 month chart if we can, because I think this development of signing a deal for 2 additional APIs with Fermion came in sometime in the last 1 month. The stock has gained about 10%. Accumulation there. A large ex-promoter, currently public shareholder, has sold 12% stake, absorbed by some very smart investors, and which explains why the stock was up 5% or 6% up in trade yesterday, and another 5% up today, because clearly the market senses that a supply overhang which would have been in the market, because 12.5% is a large stake, that is out of the way, largely. And now if you look at the fundamentals, expensive as the stock may be, the future potential might be looking good. And maybe which explains, I mean, investors can go wrong every now and then, but for Malabar, for ValueQuest to put in the funds that they have, and Malabar increasing the stake into this one at the current point of time seems interesting. And as Varsha laid out, that there are some triggers out there which, if executed well, could augur well for AMI Organics.
This is more medium to long term, right? In the next 1 to 2 years.
All chemical companies, I think.
The next 2 quarters will still be rough.
For most companies, yes.
So I think that once you get beyond that is when you will really start seeing actual change in how the stock valuations also play. But Niraj, you talked about how the stock is still expensive. If we are anticipating the next 2 quarters to be rough, is the quarter after that already baked in, and hence the expensive valuation of a correction from here, and then of course a recovery is what the street would like to see?
Yeah, good question. So all of these names, I mean, this plus the fluorination companies were trading at stratospheric valuations.
Yeah, they were the darlings of these 3 years ago, right?
And they've come off a little, but even after coming off, they're much expensive relative to others. But let's say people are still buying into them.
In fact, Hiren was talking about it. That's one space that he likes a lot.
He said, Mihir Vora said that Spec Chem is the pocket to look at.
So 2 more quarters and hopefully they will be back to being darlings.
The question is, are people talking about hotels?
So I had a very interesting conversation with Patanjali Keswani of Lemon Tree. We're going to play that out after the break. And the most, the biggest takeaway actually from him is how he sees that the moment we hit that per capita income, which will move us into developed economy level, the occupancy rates are going to go through the stratosphere. So a long-term bet for the space. That conversation coming up after a very short break. Stay tuned. watching NDTV Profit. Today on the show, we're speaking with Patanjali Keswani, Chairman and MD of Lemon Tree Hotels. Now, the hospitality space has been an interesting one, and Q3 is one to watch out for a number of marquee events. You had the festive season, wedding season, World Cup, and now, of course, the December year-end rush. What is the picture panning out like? Mr. Keswani, welcome to NDTV Profit. So glad you're speaking with us today. Let's begin with that overview on Q3. Was it all that it was made out to be? When we were seeing exorbitant, room rates on social media for various occasions, tough to get a room at a decent price. That's great news for Lemon Tree, isn't it?
Hi, Tamanna. Thank you for having me on this show. Well, Q3 actually, I think very often we get confused between festive season and demand. So when you have business hotels, and we have many of them, the demand is actually quite low during festive season because people don't travel, for instance, during Diwali or Dussehra. So while social activity is high, business activity is low. So for business hotels, in fact, Q3 is never as good as Q4. But for leisure hotels, certainly it is. So in our case, we have, only 20% of our portfolio is in leisure. So those will do well. And the others, which is the business hotels, typically do lower occupancies during this period. And it's an annual thing. Every Q3, you have Diwali and Dussehra. And God help you if it is in the middle of the week in November, because it significantly affects demand in what is traditionally a very high demand period.
Now, fair enough, but this time was different, and which is why I also mentioned World Cup, where I think all rooms of all categories were in great demand. Was that helpful to you at all? Is wedding season looking interesting, and would you say that same sort of business hotel slump will be seen year-end? How is that picture working out?
Well, certainly wedding season helps us, and the World Cup helped us in Ahmedabad and a little bit in Bombay and so on. But those are one-off events. You get me? So they don't move the needle across a full quarter, which is 90 days. So to answer broadly, the fact that Diwali was in the middle of November this year as opposed to last year when it was in October actually muted demand in October, which is a very high demand period otherwise. Weddings, they're certainly on the on the rise, and we are capturing more and more of that market, so that did compensate to some extent. As far as the year end goes, Christmas and New Year's is again a period somewhat similar to Diwali and Dussehra. So our hotels in Goa will do well. Our hotels in some other leisure destinations will do well. But our large hotels in the cities will not do as well as they would do in a normal week as compared to the year end.
Fair enough. So let's look forward. Let's look forward to Q4 and the average room rentals that you're seeing. Are you seeing an uptick there possibly? Are you seeing an improvement in occupancy rates coming in?
Yes, absolutely. So Q4. So look, if you look at this business, which is somewhat cyclical, even within a year, it is. So one is it's cyclical over a cycle, which means it's a function of demand supply over an extended period, over a decade. So let me give you some context. The hotel industry, the cycle is typically, say, 10 years. And an interesting principle applies that whenever the demand goes beyond supply, and this is a little bit like the oil industry. So let me give you further context that in the oil industry, if demand goes up by 1% globally, prices go up by 10-15%. Okay, and why is that? Because it's got a limitation on supply. You cannot add supply quickly. It takes years to add supply, and therefore a small delta in demand growth means prices go through the roof. The hotel industry is not fundamentally dissimilar because you cannot put supply up overnight. It takes years. So whenever demand is beyond supply, the prices grow disproportionately. So that is our business. Now, when I look at Q4, Q4 is traditionally a period when demand is highest among the 4 quarters. If you look at a full year, then H1 is when about 45% of your demand is generated, and in H2 it is 55. So really H2 is 1.2x of H1. And within H2, Q4 is 1.2 times or 1.1 times Q3. So every year, Q4 is the best quarter. And for us, as I see our forward bookings, it will be somewhat of a record-breaking year for us, a record-breaking quarter, to be specific.
Why is that? Can you add some more details there? Why will it be a record-breaking quarter in terms of occupancies, ARRs, or both?
It is both occupancies, ARRs, and the fact that we have opened the biggest hotel in India, which is in the deluxe segment, the 5-star plus segment, which is the Aurika Hotel in Bombay.
Yes.
And that alone will, be a gangbuster performance. So if you add it as some of the parts, the same hotels, as you call same stores, will themselves do significantly better. And then add to it Aurika itself, which will contribute 20% of our revenues, and over time maybe 30% of our EBITDA. That has got stable in this quarter. But look, I would like you to look at it slightly differently.
Okay.
I think whoever I talk to in the media or in the investing world, we always look at the hotel industry from the perspective of cyclicality, seasonality, and what is demand growth and supply growth in the short term. But I think something that is not yet been recognized, and I have no doubt it will be recognized in the next 2 years, is the change in consumption patterns. So in India, as a matter of fact, and I'm going off the hotel sector, I'm talking about the consumer discretionary sector. India is at a very interesting point. See, at different levels of per capita GDP, there will be cohorts of consumers who move from discretionary to non-discretionary consumption of certain categories of goods and services. Let me give you an example of this. If you look back 20 years, the choice of traveling between Bombay and Delhi was between traveling by rail and or going by air. A very tiny portion of India would treat air travel as the default. That is, it would be non-discretionary. Today, look at the rate of growth of air travel in India. And the fact is, and as incomes in different segments keep increasing, those very categories of consumers who are also aspirational no longer think of traveling by train. They only think of traveling by air. The point I'm making is that what used to be discretionary has now become non-discretionary for an increasing number of customers in India as far as air travel goes. The same story applies, for example, in cars. 25 years ago, Maruti 800, and today, a heck of a lot of people now buying cars worth at least 10 lakhs or more. So these are inflection points in different buckets of consumption. The inflection point for the hotel industry really comes at about $3,500 to $4,000 per capita, when a very large portion of the population demonstrates a marked preference for branded mid-market hotels. You can look at China, you can look at Taiwan, you can look at every economy that grew through this, and you will find that hockey stick change in demand occurred at that point. What am I saying? I'm saying if the economy is growing at 7%, then yes, every year demand grows at 8-9% for the hotel industry, right? But there is one point in the economy, in every country's economy, when the number of consumers at a certain level of GDP per capita start treating that category as non-discretionary. And the hotel industry in India is 2 years away from that. So, at which point, Tamanna, you are not talking 7 or 8% demand growth. You're talking 3x, 4x demand growth.
Okay, so I'm going to ask you why you think we're 2 years away from it, and because you have properties in all categories, are you seeing this shift upwards to, for example, an Aurika, which, your projections have increased from 15 to 20 to now 30% of revenue. Are you seeing that shift upwards in numbers in a very clear way, in a very clear fashion?
So here's the deal. Let me just give you an analogy. 3 or 4 or 5 years ago, before COVID, let's assume the number of consumers for mid-market branded hotels was, say, 10 million households. Okay, which is roughly 45 million people, 4% of India's population. Today, that number is no longer 10 million households. An increasing number of people, because India's GDP has grown 30% since then, the number of people who can afford mid-market hotel rooms has tripled. Okay, the number of people who can afford luxury, what you are talking about is premiumization.
Yeah.
That has probably grown 5x. So luxury demand in India, whether it is for hotel rooms or business class tickets or just nice handbags or, branded products, is going to, in my opinion, is already on the route to taking off. The mid-market is a couple of years ago. Now, why do I make this point? I'll tell you an entertaining anecdote. I read that in some markets, when mid-sized SUV consumption takes off, the hotel demand takes off 4 to 5 years after that. So as I said, as an amusing aside, I'll tell you, every time I sit in my car and I look out, I count the number of mid-sized SUVs. And I was very pleased to hear, even from Maruti Suzuki, that they now regard that as their most important market.
Yeah.
So these are proxies, these are, ways of assessing. But I can tell you on ground, I can see this move. I certainly see it in the premium segment. In the premium, it's a little bit of a tongue twister, but in the move in luxury demand and mid-market brands typically follow 2 to 3 years after that.
So in terms of where your average room revenues will move with this trend, what is that trajectory looking like? From about
so I'll take you back.
5,000 odd right now, 5,200 odd right now.
We are now at about 6,000 ARR, but that's a blended average. So our lemon tree premiers would be at 7 to 10,000. Our lemon trees would be 5 to 7. Red foxes would be about 4 to 6. So you're talking of an average.
Yes.
And these are different consumer cohorts again. So if I go back, you tell me the prices are high, and I said in a recent interview that that's incorrect, because 15 years ago, compared to 15 years ago, which was the last top of cycle in India, in the hotel industry, my prices are 30% below that today. So 15 years of inflation, 15 years of holding assets, and my prices today are 30% below what they were at the top of the cycle. So here's the point. Top of the cycle is purely a function of demand exceeding supply incrementally annually, which is already in play as we speak. That will lead, in my opinion, to a 10 to 20% increase in prices across India in different markets, where obviously in some markets demand growth is greater than supply growth by a certain level, and in other markets it is perhaps less. So depending on those factors, your prices will go up between 10 to 20% in markets. Blended, maybe 12 to 15. But if this hypothesis, which I just shared with you, plays out, which is an increasing number of people treating branded hotel stay as non-discretionary, then prices will go through the roof. Then I don't even want to speculate where it will be, but I do know that there's a saying, you ain't seen nothing yet. And I think that's where we will move towards.
So when you're saying prices go through the roof, you think demand will keep up?
Absolutely, because it is not the current demand that is growing. It is new cohorts of consumers who have started to also consume this.
Okay.
All right, back with India Market Open right here on NDTV Profit. A very special guest during our launch period. Prashant Khemka, founder of White Oak Capital Management, joins us in our studios. Prashant, thank you firstly for being in our studios and for coming from Singapore to India a day early. I'm taking a little bit of credit for that, for being on my show.
No, absolutely. Fair to take that credit. Thank you for having me here.
No, the pleasure is entirely ours. So, lots happened in the last 24, 36 hours. I know you don't look at it from a prism of what's happening day by day, but there's a lot of skepticism in the markets currently around the frenzy at the broader end of the spectrum, the mania of what's happening in the IPO space, not just SME, but the main board as well. And everybody talking about how there are telltale signs of this approaching an exuberance period. But at the same time, people say, yaar, Sara market exuberant nahi hai. My panwala is not giving me tips. Everybody is not in the same bus. So we are far away from the top. I would love to understand how you are looking at risk assets globally and India as well.
No, certainly. I think the telltale signs that you're talking about, they're very much there. So if you compare, you've been in the market for long enough, so the environment is quite, it reminds you of 2017 time frame. That was the last time when SME IPOs were all listing at 100+% premiums and all. And also the huge, fundraisers and IPOs and all. That was last time. Small and mid caps had a very rampant year in 2017 as well. Before that, maybe you had to go to 2007 when the environment was very similar, 2006, 2007. Yeah, so I think we are definitely, if there is some kind of a trend line, we're definitely on the other side of trend line, other side of the average. Now, this can continue for, it's not clear whether you're in 05, 06, 07. The big rally started in March 03. Exactly 17 years later, the big rally started in March 20 from the COVID bottom. Yeah. So it's not necessary that this would go on till 25, which is 5 years. It's not necessary, but it can go on longer as well, could be shorter as well. So that's the difficult part about, it's like a party. You are enjoying the party so much. Already it's past the due time. Yes, at some point, as my boss would say, the cops would come, but nobody wants to leave because they are so enjoying the party, if you will. So it can go on for much longer, and you have to, tread cautiously, but you can't be out of it.
Yeah. The bullish argument might be more time is spent trying to wait for the correction than in the correction itself. So, are you of the belief, because it's difficult to time the top per se?
Impossible.
Right. So, are you cautious currently? Would you, given a choice on personal accounts or portfolios, sit on a bit of cash because of the exuberance currently, or are you still riding the party?
Yeah, certainly. So personally or for client accounts, I have never sat on cash. Over the several decades that personally I have invested in India or abroad in the US, so I've been fully invested at the top in 2000, at the top in 2008, at the top in 2017 and so on. But by the same token, I've also been fortunate to stay fully invested at the bottom in 2008 or 2009 actually. In the bottom in 2003 and the bottoms that have come through. So I'm firmly of the opinion, what you said often my team members or clients, when they say it is very difficult to time or call the top or the bottom, I correct to say that it is not very difficult, it is impossible. Because something that is very difficult, it can be done. It's just very difficult. But calling the market is like calling a coin, a coin flip. And the odds are similar. You'll be right half the time, wrong half the time. And the amount of time you sit out is the return that you will lose if you were to aggregate over time. So we stay fully invested at all times, and so is the case right now as well.
Well, the coin flip argument of Prashant is similar to his argument when talking about macro. That Prashant usually says that trying to figure out the call on the markets using macro is like a coin flip as well. So I just remember that conversation that we've had in the past. Okay, so so it may be a stated policy, or you following that policy that you do not try to time the market, which is fine. But would you believe that the probability of the near term market performance being a bit more sedate is higher, or do you reckon that this uptick that we're seeing, the probability is higher for the markets to inch up higher from where we are currently.
So I think it's reasonable to expect. See, the safest thing to say is that volatility would be higher. That's what all experts say, because that makes them sound smart. Yeah. So after a strong rally that we've seen over the last 12 months, it is unreasonable to extrapolate that we'll have similar returns, particularly in some of the smaller cap segments of the market. They'll have similar returns going forward as well. I think what's reasonable, at any point in time, it's reasonable, I think, from the Indian markets to expect a low double-digit return from the market. And same across large, mid, small in aggregate. In aggregate, markets are quite efficient. So the rally we've seen of about 20-odd% in the overall market and 40-odd% in mid and small, that could be very well justified if economic growth were to continue leading the world at this 7-8-odd%. Remember, in 03 to 07-08 time frame, the earnings growth at aggregate market levels were 25%, and mid and small cap earnings growth were far higher than that. If I recollect correctly, were closer to 40% or so. So if we have very robust economic growth over the next few years, which all of us anecdotally seem to agree we would, it is very possible that you see high levels of earnings growth across market, and particularly so for mid and small. And in that case, the current valuations would also turn out to be attractive when looking backwards at some point in future. It's just not possible to bet on those. It can happen, it may not happen. So that's why I say it's fair to stay fully invested at all times, but expectation going forward should be low double-digit return.
But to be fair, the broader end of the spectrum, since the COVID lows, the earnings run rate at the broader end has been pretty strong.
Absolutely.
And I've heard you mention 03 to 08 period twice already in this 7-8 minute conversation. Is this reminiscent of what happened back then? Is the cycle looking similar?
So at that time it was stronger, at least anecdotally what I remember. It was off the top of my head, and also the numbers were, as I was saying, right now the growth over the last 3 years has been 20-odd% in the aggregate market level. At that time it was over a 5-year period 25%. I don't remember first few 3 years were stronger or not. So it was somewhat strong. And we started at that time at lower levels than in March 2020, both from a broader economic and corporate earnings perspective, but also the market multiple. 2003 was a multi-decade lows, particularly for small and mid-cap. In terms of valuation, multiples would have been for the aggregate market around 10 times or so in March 2003, whereas in March 20, it would have been mid-teens or so.
Right. Now, Prashant, at our launch event, your colleague Ashish was at the launch event, and he made this interesting point about how you bet on foreign inflows coming into India at the very start of you setting up White Oak. I mean, it was expensive maybe to set up structures in foreign jurisdictions, but you did that because you preempted that India will see flows. Now we're seeing asset manager after asset manager talking that 6 years out. Today, I think we put out something that Natixis Asia economist has put out about how they are very constructive on the structural story of India. PM Modi gave this interview to FT as well. When you think about managing these large sums of money that you do as well, do you believe this cycle is very long? And I'll come to specifics as well, but I'm just trying to understand, when you're thinking about asset management currently, do you reckon that the probability of making double-digit returns, high, low, whatever, over the next 6-7 years is high? And therefore, even if people miss out on the early pop, let's say, it is still wise to make fresh investments or stay invested in India, because you miss out on backdated returns eventually if you try to worry about the 3, 5, 7% currently.
Certainly. No, very true. I have seen over last many years, many investors globally, if I were to talk about, perennially worrying about Indian valuations. We've in fact written a newsletter. One of the 2 newsletters we've written about is about the Indian premium. Yeah. So I think the biggest mistake investors make is comparing India's P multiple with rest of the world, be it China, which is the favorite comparable for investors, or be it emerging markets average or global average, and so on. I think India has a couple of attributes that in combination provide a unique combination, if you will. So India is the largest democracy globally as well as in emerging markets. It's a well-functioning democracy. It is one of the fastest growing economy. So this combination, and plus corporate governance, despite all that anybody says, having invested across EM as well as developed world, certainly I'm confident in saying corporate governance in aggregate in India is superior or second to none in the emerging market space. So if you combine these three, and the aspect about democracy also is related to governance at a national level. In authoritarian regimes, the respect for property rights is very minimal. There's no recourse to law because the authority itself is law. Yeah. So whom would you appeal against them? In India, it's very routine for people in India or global corporates like Vodafone sued the government and still could expect to do business in India. Yeah. How many emerging market countries, and think of authoritarian countries, and how many authoritarian countries can you sue the government and still expect to do business in the country? Certainly can't happen in China. Obviously now Russia is no longer in EM basket, but can't happen in Russia, and so on. So that is very valuable. Yeah, people used to often complain that in India, building national highways and all is such an arduous process. You announce a project and then it takes decades to complete it because one small farmer can sue the government and hold up the process. Whereas in China, the Three Gorges Dam displaced millions of people, and within a whatever short number of years, such a massive feat was accomplished. To me, I would always challenge the on the other side to the client that, isn't that worrisome that a country, I mean, in not just particularly China, if a country does not respect the rights of a small farmer, would it respect rights of foreign investors?
Sure.
How much confidence can you have in that? And if India as a jurisdiction respects rights of small farmers, then it's quite possible it would respect rights of foreign investors as well.
Sure.
And ultimately, equity is nothing but a contractual right to perpetual cash flows of the company. And those rights are valuable only if those rights have sanctity and would be upheld in the jurisdiction. And hence India commands a much higher multiple globally, and this aspect has, I think, increasingly being recognized consciously or subconsciously after the events of last 3 to 5 years at the global stage, including what happened in Russia, including what's happening in China during COVID, but also post-COVID, and so on and so forth. And hence the multiple expansion, relative multiple expansion, has gotten further entrenched. And I believe you would see a massive influx over the coming year, unless there's some untoward incident between now and then. You would see a strong influx of foreign money in the country.
Got it. So Prashant, tell me, and I would love to get into the micro as well, but just one macro question, because you have a great pulse on foreign investors and the money that is coming in. In your conversations, whether or not they invest now or they invest 6 months or 12 months down the line through you or through some other asset managers, but are different kind of large global investors looking at India now relative to what it would have been, say, maybe 2 years ago or 5 years ago? And give us some color about what is this.
No, absolutely. A lot of new investors globally are looking at India for the first time. A lot of investors who've been looking at India for a long time are at a point where they want to action the decision. So few things, if you have to, understand why. First, we've already talked about, everyone knows India is growing and democracy and the economy is now headed towards 5 trillion and so on. All those things are very well the contributory reasons, but also understand that in emerging markets index, MSCI EM index, till about 10 years ago when I started managing the EM portfolios for the first time at my prior firm, China was north of 30% in the benchmark, and with the changes that MSCI was going to undertake by including the domestic A share market as well, it was headed towards 40%. Yeah. So for decision makers, asset allocators who are looking ahead, they're already saying China's 40% of emerging markets have to have allocation. Yeah, pension plans, sovereign wealth funds, and so on. They would have dedicated SMAs or allocations to China. 40% is being huge. Within EM context and even within global equity index, China was, I think, around mid-single digits or thereabouts. In contrast, India in 2013 was smaller than Brazil in the benchmark index. Some of it is our own doing because we have so many restrictions, like in banking sector, 74% is the cap. It has a certain unforeseen or more complicated impact that the largest bank, which is HDFC Bank, is not in the index. Yeah, that impacts hugely the weight of India in these indices. But leave that aside, or be that as it may, India's weight was around 5%, 5 to 6% at that time. So think of China close to 40% in investors' mindset, and India at 5 to 6%, smaller than Brazil.
Yeah.
You can easily ignore at that point in time having a separate allocation for India. Yeah, because first you have to deal with China, then Brazil, and then maybe come to India. Where we stand today, China is now 25-26% of the benchmark, down from 40, and what was expected to be 40, and India has grown from 5% to close to 17%. So the math has suddenly gone from China being 6-7 times larger to India to now only 1.5 times India in the benchmark index. And hence, and the direction and the pace at which these are moving, India has rapidly risen on the totem pole, if you will. And I would say it is now top priority ahead of China for most institutions.
But not just passive. What I meant was people who are not looking at the index necessarily, but coming to managers like you.
No, this is active.
This
very
is
much active.
Okay, you're talking about active. Sorry, excuse me.
Because ultimately, see, any asset allocator is measured against something.
Yeah, okay. So the benchmark is that.
So the benchmark ultimately gets into effect.
Okay. So a very new set of investors are starting to look at India in conversations with you as well?
Yes, absolutely. New set of investors, past set of investors who were invested in India till, let's say, 2013-14. Because what's happened also, Niraj, is over the last 10 years, there's a growing disenchantment with emerging markets in general. Because emerging markets have not delivered anything.
Yes.
Over the last 10 years, the returns are zero. And developed markets have done very well. US in particular, yeah. So a lot of investors who were invested either in EM or in single country, like India, who all started investing during the BRIC phenomenon of 2003, 4, 5, 6, 7, but they all exited after 2011, 12, 13, 14. Now those are also coming back.
Sure. Okay.
And India is kind of the entry point for those. Many who had only invested in China as a separate, so EM, a lot of investors who, it's like, in India there are various types of vegetarians.
Yeah.
One is complete vegan, one who eat egg, or one who eat milk and then eat eggs and then eat chicken and so on and so forth. So there are investors also of various types, and now India has become particularly attractive, which was not the case earlier.
Got it. So when investors are asking you about, and you've already told me that India will trade at a premium. So I'm trying to now understand, when you're trying to design these portfolios, really from a long-term perspective, and viewers, some of the viewers who heard you through our conversations know that you have a valuation metric, which is the OPCO and the FinCo. So that is well established. But therefore, when you're trying to figure out where is it that you would want to take advantage via your portfolios for the next 3, 5, 7 years, what is the design of the portfolios currently, keeping in mind that you have a healthy mix of long-term global investors, but at the same time you run a very active mutual fund business as well, which is very retail. So what's the portfolio like?
Certainly. So I think the basic approach of the firm is very, very similar. So the MF team headed by Ramesh Mantri runs it. The broad contours are very similar as to how we run the global assets, which is that broader market investment opportunities we look for. We don't have any strong preferences, though since alpha opportunities are larger in mid and small cap space, we always have higher allocation in mid and small cap space, which remains today as well. Yeah, though in MF space, obviously you have large cap fund, flexi cap fund, all those are different, so they cater to those guidelines and principles. But if I talk more broadly for the offshore funds, it is, think of it as a flexi cap product with roughly 40% in mid and small and 60% in large, and then as across sectors. Historically, it's always been the case, and today even more so, I would say, that the team finds some outstanding opportunities in financials. In large cap, mid cap, small cap, across the market cap spectrum, financials haven't participated to that extent in the rally this year. I think that has made, and when we look at financials relative to other sectors, on valuations and prospects, when we look at Indian financials relative to where the similar financials trade across the world in emerging markets or developed, I think at this point we are finding most compelling opportunities in financials, and that is the biggest segment in the portfolio of exposure, followed by, I would say, consumption-oriented opportunities and technology, IT services, as well as some of the new age companies which obviously went through a very volatile phase over the last 2 years, and after a torrid or horrible 22, they've stabilized to a greater degree, both on the business front, more particularly in the business front, as the competitive dynamics have evolved with the, with free money not being available anymore, and competition hence in check.
Okay, well, we'll talk about some of these in greater detail on the other side of this very quick break. Need to take one. Viewers, stay on. We'll come back in just moments from now. Back with India Market Open in conversation with Prashant Khemka. We've established that he believes that while there are low double-digit returns in the market, but the returns could be there for the foreseeable future. And just before the break, he told us about how he believes, or the team at White Oak believes, that financials, technology and consumption remain the bulwarks of their portfolios? I'm inclined to ask, though, before I probe them, and we'll do a bit of a rapid fire now of sorts, but while these remain the principal bets, have you been enthused by the advent of newer sectors in the last few years, last 2-3 years? So you mentioned tech-enabled businesses as one, but there is the resurgence of defense, the comeback, if you can call it, of PSUs, and just suddenly, EMS, railways, all of them have come to the fore. Have these excited you? Have you been able to do the OpCo-Finco model for these as well?
No, absolutely. So OpCo-Finco is basically an enhanced DCF. Wherever you can apply DCF, you can apply OpCo-Finco. In fact, we've even applied to financials where DCF cannot or isn't usually applied. But that aside, so yes, when I mentioned not to mischaracterize the team's views or how it manifests in portfolios, so financials, consumption, technology, when I mentioned these are the largest chunks. In the benchmark also financials 25-30%, so it's likely to always be also the largest in the portfolio. So financials, say about 25 to 35% in the portfolio. Consumption, when you put together discretionary and staples, can be 20-odd% in the portfolio, 15-20%. Technology, double-digit % as well. But then there's a whole slew. So if you add these together, 30, 20, 10 is 60% of the portfolio.
Got it.
The remaining 40% would be in a whole host of other areas, including defense, cement, PSUs. You mentioned there'll be a whole host of those names in the portfolio.
Where would you be contrarian, Prashant? One, where largest contrarian bet, if you will. Why so? And if being contrarian, I do not know, but if being contrarian is, if it has hurt you in the recent past, what is the rationale for holding on to some of these bets? I have no idea about where you are contrarian, but I'm asking.
So I would say over the last 2-3 years, and continues to be the case here, the biggest contrarian position in the portfolio, I would say over the last 5-6 years, has been our exposure or investment in IT services.
Okay.
Yeah, particularly mid-cap IT. So, like I was telling, financials, we find strong opportunities across large, mid, small. In IT, we've always found a lot more attractive opportunities in mid-cap space, mid as well as small. So, going back to when we started in 2017, August 2017, White Oak, we had fairly large investments in IT, particularly mid-cap IT. That played tremendously well for the portfolios in 18, 19, 20, 21, some years more so than other years. And then 22 was a horrendous year for IT services as the US demand slowed down and all. Because of that, these names were down 20, 30, 40% in a year where the market did very well. Now in 23, while the stock prices have recovered for many of the mid-cap IT as a sector overall hasn't done better than the market, but hasn't done terribly like 22. But mid-caps have done very well, and we are at a point where skepticism, despite these mid-cap names or overall IT not having done so poorly, the skepticism in the market is still very high. This is always how it happens. Be it at the market level, individual sector levels or whatever, the stocks could do well, in fact often do well in the face of such skepticism. We believe that looking forward from here, the opportunities over a longer time frame, and to your question of, why did you stick to them and all that, because by the time you realize, US is going to slow down, the stocks are already down 30%. Yeah. So stocks slow down. The stocks started collapsing late 21 onwards at a point in time when the demand environment was very robust and forecasted to remain robust. So we are, historically, if I look back at my investing career, most of the money has been made through stock-specific stock selection, and not by calling these trends at a sectoral level or a macro level, which is what I call in the coin flip category. Sometimes you go right, other times you go horrendously wrong. Like post-COVID, a lot of people took a call that the sector to be in going forward is pharmaceutical, because everyone would be popping pills for the rest of their lives. But it didn't turn out to be that way. It's been a dog of a sector after the first few weeks of COVID. So we never make these top-down calls, and that was the case with IT also. We didn't make that top-down call. We believe Indian IT services would continue to, at an aggregate level, gain market share globally. Within that, the best execution machines in Indian IT services would gain market share relative to the overall industry. Yeah, and the business model has shown over the years, over the decades, to have generated huge value creators.
Sure.
And several of the small cap, when we invested 6 years ago, there were small cap names have already become mid caps or large caps by now, and that's the expectation going forward.
Proponents of the IT-enabled businesses, the tech platforms, say that globally these businesses are large portion of the indices. India, we don't have so. At some point of time, they will become large participants of the index as well, and therefore the runway for growth is very large and very long. Would you be of the same thought? What is the idea of staying in these businesses?
Yeah, so let's say the conclusion is right, though the rationale for investment may not exactly be that because this would become large components of the index and that's why we should be investing in them. They'll become large components of index because they'll end up being, highly profitable cash flow generating companies.
Of course.
So the reason to rationale for investing is more identify opportunity, and it's not a generic statement. A lot of them would go out of business, like has happened everywhere in the world. But the successful ones would end up generating huge amounts of cash flows, and their valuations in hindsight would look like peanuts compared to what they would eventually become. And like with any other sector in any other part of the world, our job is to try and look for those opportunities. Yes, we'll be wrong many a times, but then hopefully right at other times if we are doing our job correctly.
So there are different segments here because it's a very diverse sector. What within this landscape do you like more? Is it food delivery? Is it payments? Is it fintech? What do you like?
So there isn't a preconceived viewpoint that we like this segment better than the other. You have to evaluate basis, what is the competitive dynamic here? Obviously, what is the TAM, total opportunity size, and how have these businesses evolved in other markets, in China, in Korea, in US, and so on? How is that different, though? Not everything is comparable to these. How is it different in India? And in that Indian context, how is competitive intensity evolving now? And what are the strengths of the company under consideration? What are the sustainable advantages, competitive advantages of the company under consideration in the context of that competitive intensity? Many times it might just be the sheer execution capability. When you look at some of the NBFCs in the Indian market, I can't name names, but NBFC is a cutthroat competitive market. Over the last dozen years or 2 dozen years, a couple of decades, some NBFCs have done phenomenally well. And other NBFCs, we don't remember their names because they had to be bailed out or have gone under. What differentiated them is the execution capability and not the rosiness or the opportunity in NBFC space.
Yeah, but having said that, we are just out of time completely, but I would just love to understand, because I can't get into names. I'm just trying to understand that the reasons, background reasons notwithstanding, where is it that you found favor? In which segment within that internet space? Is it a fintech? Is it delivery? Is it payments? What is it?
So I would say it's not. I can say what it is not. So it's not fintech. We haven't found great opportunities in fintech space or in payment space and all. But otherwise, there are several opportunities outside of that. And don't remember, it's not just companies that got listed in a year or two. There have been some of these companies in the new age space that have been listed for a decade or two.
Okay. Point well taken. Okay. But we are out of time completely on this show. But Prashant, take a moment to thank you for joining in today in our studios. Great having you, and look forward to have you more often.
My pleasure, Niraj. Always a pleasure to see you.
Thank you so much.
Thank you all.
Thank you. And viewers, thanks for tuning into this leg of India Market Open. We leave the markets in fine fettle, about 0.5% higher in trade. The FNO show takes forward all the derivative action on the other side.